Three, one. All right. Hi, I'm Judah Ross with Bastrop Real Estate Group. And today I've invited my good friend and a loan officer, Annie, to join us and to talk a little bit about what the loan application process is like. What are some common questions people have and mistakes to avoid? But Annie, first of all, thank you so much for joining me today. How you want to introduce yourself real quick?
Yeah, 100%. Thanks for having me, Judah. I really appreciate it. I'm super excited about this because something that I see very often, and I know you do too, is that fear typically drives our decision. And a lot of people want to purchase a home, but they actually won't reach out to a realtor or a lender because they are fearful of not being ready to take that next step. And so instead of reaching out and seeing what they need to do, they just don't do anything at all. So I'm super excited about this.
Awesome. Yeah, that's really my goal here as well. And I totally understand that mindset, but it can be a big step for people to reach out to me, if they want to purchase a home, and then we go look at a home, and I tell them the next step, hey, we need to get pre-qualified to see what we can actually afford, if we can buy this, if we can afford something more. And I know that can be a very intimidating process. So I wanted to cover what that process is like, dispel some of the myths maybe that are pretty common. But let's dive into it. So say, I'm working with a buyer. We go and see a home. They really like it. And they say, hey, we want to purchase it. What's the next steps? We want to get pre-qualified. So I put them in touch with you, Annie, and what's that initial call going to look like?
So the initial call, what we're doing is we're chatting about there are a few things that I like to know about my buyer. The first is what are their goals? What are they looking to do? And where are they looking to purchase? And what do they want their monthly payment to be at or around? From there, what we'll do is then we're going to chat about their employment history. We'll chat about what their credit scores look like, and we'll chat about if they have any money saved for down payment. Now, typically during this time, it's a 10 to 15-minute call. It's not very long, but I'm really diving into what's most important for that buyer. Is it a lower monthly payment? Is it, hey, I have no money saved for down payment? Is it, I have to get out of my lease right now, or I don't have to be out of my lease for another 6 months? And where do I need to be? So it's really just trying to figure out what's most important to that buyer. From that point, what we'll do is complete an application. And so we have our conversation over the phone. Then I send them the mortgage application. Takes about 20 to 30 minutes to complete. It's a questionnaire. Once they complete that questionnaire, it then asks them for documents. Depending on if the borrower wants to get pre-qualified or pre-approved, I will get, okay, stop. We're going to have to edit this.
No, no, this is good. Can you and I will, but no, you bring up a really good point, Annie. Can you tell me the difference real quickly between a pre-approval, pre-qualification, and a pre-approval?
100%. So what a pre-qualification is a borrower completes the questionnaire that takes them 20 to 30 minutes. They're going in and they're saying, hey, I work at HEB. I make $20 an hour. I make $2,000 a month in overtime. I have this much money saved. A pre-qualification is taking that information that you have manually input, and it's me pre-qualifying you based on that information. A pre-approval is going a step further, and it's getting the documents to verify that information. A pre-approval stands on more solid ground, especially when you're putting in an offer with a seller, because we're doing all the back end work that we need to ensure that the loan is not going to get denied midway through a transaction. There are a lot of caveats that we have to pay attention to when reviewing these documents that borrowers are unaware of. And so my personal preference is to get every borrower pre-approved if we can, because that just ensures it's being proactive versus reactive, making sure that we're giving them valid information up front, like, hey, you are pre-approved for $300,000. And knowing, without a doubt, hey, you're solid for 300,000, go shop. Whereas a pre-qualification, it's like, hey, you're pre-qualified for 300,000, but I haven't verified your overtime income. I haven't verified where your money for down payment is coming from.
It's still pending
So
some verifications.
exactly. Yes.
So in order to submit an offer, if my buyer wants to submit an offer, we have to have a pre-qualification. But you'll usually take it a step further and actually get them fully pre-approved, and that'll make the process much easier when we're under contract on a home as well. Is that correct? Because you already have
Absolutely.
verified a lot of
Yes,
it.
sir. We have everything that we need we have the entire loan file ready. So all we need is that contract to pair with it. And so it goes directly into underwriting. It's a lot smoother process.
Okay. So they have an initial call with you about 10, 15 minutes. You're going to ask them their goals, monthly what they want their monthly payment to be, find out a little bit more about their employment history, about their credit, and if they have savings for down payment. And then you'll send them over the application, and this is a questionnaire, and then they'll have some documents that they need to upload. Is that correct?
That is correct. That's
Okay.
perfect. Yeah,
Awesome. So, and this is good for me. I've dealt with the process myself, of course, buying a home, and then, I'm helping my buyers, but I want to be more educated about it as well, and to be able to guide them along, and then let them know what the process is going to be like. And we work together as partners when we're helping a buyer, but I always want to be more educated about that. Now. Um, when you mentioned savings,
hmm
a lot of people are concerned they might not have enough money. A lot of people have in mind that they have to have 20% saved for a down payment. I know there's a lot of myths and maybe misconceptions about this. Can you address, like, what's the minimum down payment? How much should people have saved up? What do they need to have saved up?
Absolutely. So the number one misconception in lending is that you have to have 20% down to purchase a home, which is
Mhm.
not true. Um, there are various programs available. So there are loan programs that will allow for as little as 3% down with qualifying, right? There is a loan program that offers no down payment, a no down payment option. And then there are down payment assistance programs as well, grant programs, and then true down payment programs. So, what I mean by that is a true down payment program is going to act like a second lien on top of your first loan. Okay.
Okay.
So let's say that your loan requires 3% down payment and you're looking at a $200,000 home. Then you're going to be required to bring 3%, $6,000 for down payment. A true down payment assistance program is going to take that $6,000 and it sits on top of your first loan. So you have your first loan is going to be 194,000. Our second loan is going to be 6,000 on top of it, right?
Okay.
Then there are grant programs through the state of Texas that roll the money into essentially your interest rate. I don't want to misinform anyone in the sense that money is never free. So when I think of grant, I truly do think of free money.
Mhm.
The interest rates on those grant programs are a little higher. And so just so, and I try to inform my, I say I try, I inform my buyers of that. When we're looking at the various options, down payment program versus a zero down payment loan versus a grant program. We look at all of those, compare and contrast, and make sure that we're meeting the client's needs.
Gotcha. Okay, um, so if I'm understanding correctly, for typical loans, it can be, is it for FHA, it's 3.5% down is the
Correct.
minimum, and then conventional is 5% down. But then there are often grants available that sometimes the interest rate may be a little higher, or it may be an additional loan. But you're saying that people can actually get into a home for as little as zero down?
Correct. Yeah. And I do want to, education wise, I want to kind of circle back because, and I'll go through the four major loan types and
Okay.
then chat about what the minimum down payment requirement is on each of them.
That would
So
be wonderful.
there is conventional,
Okay.
FHA, VA, and USDA. So FHA, USDA, and VA are government insured loans. Okay. And then conventional loan is your standard everyday loan. So on a conventional loan, a first time home buyer could qualify for as little as 3% down on a conventional loan. Now, the reason why I say could is because we know if the borrower qualifies once we run underwriting on the file. We can't guarantee that 3% down. But
Okay.
um, FHA has a minimum down payment requirement of 3.5%. USDA has a minimum down payment of $0. That's your zero down loan. And then the VA loan also has no down payment or zero down payment for our veterans.
Gotcha. So, the VA loan, so that's of course only for veterans.
Mhm.
Um, what about USDA? Is Bastrop, we do a lot of business in Bastrop. Is that an area that's eligible, and what are the other requirements for a USDA loan?
That's an awesome question. So the USDA loan is a phenomenal loan. It is a rural loan.
Hmm.
So the property itself has to qualify. So the property that you're looking at or a buyer wants to purchase has to fall within USDA property eligibility. And that property has to be so far outside of a metroplex.
Okay.
In yours and my instance, most of the time we're dealing with the Austin Metroplex. And so, fortunately, as of today, all of Bastrop County falls within USDA financing
Oh, that's awesome.
approvability. Mhm. The second qualification for a USDA loan is that the borrower has to make less than the area median income for the county. So
Okay.
for Bastrop County, the area median income is $126,000.
Okay.
Um, we do have to take into account every single person that's living in the home. So if you have, let's say, a single mom who has her mom living with her, but the mom is not going to be on the loan but receives Social Security income, we have to take that income into consideration when qualifying a buyer for a USDA loan.
Okay.
So, but those
So
are
it's
the
it's
two.
total family or total household income.
Yes, sir. Yeah,
Gotcha. Okay.
but it's
And
a really
then
phenomenal loan product.
that it does sound pretty amazing, especially with zero down. Now, most of the buyers I work with, they're going to be doing either FHA or conventional.
Mhm.
How would you advise someone to choose between the two? What are the pros and cons to each?
Oh, that's a hard question. I say hard because it recently just kind of changed. So I am going to give quite a lengthy response to this. So it
Oh,
really
that's
is going
fair.
to depend on what the market is doing.
Okay.
So what I tell all of my buyers is, we'll start out with the four. And if they're not a veteran, then that takes us to the three, right? Conventional, FHA, and USDA.
Hmm.
These three loans, FHA, USDA, and VA, they're the government insured loans. I know I had mentioned that. But
Right.
government insured loans, essentially, the government is insuring the bank. If the borrower were to default or foreclose on the loan, the government is going to insure that bank. Interest rates are dependent on risk. So that in turn makes those loans less risky to a bank, right?
Hmm.
You follow me so far?
Yeah.
Okay. So typically the three government loans are going to have a lower interest rate than a conventional loan. Okay. But
Hmm.
that doesn't mean necessarily that the government loan is the lowest cost loan. So let me expand on that. Utilizing a government insured loan comes at a cost, and that cost is what we call the funding fee. So of these three, you have FHA has a 1.75% funding fee.
Okay.
USDA has a 1%, and the VA is on a scale. It starts at 2.2%, depending on the veteran status, military status, their retirement, and how often they've used their benefits. So,
And can that funding fee, you're probably going to answer that, but can that funding fee be rolled into the loan, or does that have to be paid at closing?
yes, it can.
Okay.
So a lot of people are like, what in the heck is a funding fee? What does that even mean? So let's take FHA for example.
Hmm.
If our funding fee is 1.75% on an FHA loan, if your loan amount is $100,000, you're going to take $100,000 times 1.75%. Your funding fee is $1,750. You roll that into the loan, so your loan
Hmm.
amount then becomes $101,750.
Okay.
Um, the conventional loan does not have a funding fee because it's not government insured, right?
Hmm.
Um, the third attribute that will kind of determine which loan we go into is mortgage insurance.
Okay.
So, um, first is going to be the interest rate. Second is going to be your funding fee. Third is going to be mortgage insurance. And the mortgage insurance rate, so mortgage insurance, let me pause. Mortgage insurance is the lender's insurance against the loan. Okay.
Okay.
Mortgage insurance is required on every single loan, excluding the VA loan. Veterans don't have to pay mortgage insurance, but mortgage insurance comes through on your as a monthly payment. Okay. So the conventional loan, if you put 20% down, you don't have mortgage insurance. Okay.
Gotcha. Is that where the 20%
Misconception comes from.
misconception comes from, that it's required?
That's
Okay.
exactly where it comes from.
So the only
So
difference is 20% you don't have to pay the mortgage insurance.
correct. Yeah. And
Gotcha.
mortgage insurance
On a
can
conventional.
be $30 a month to $300 to $600 a month, right? It just depends
Okay.
on the health of the borrower's loan file.
Gotcha.
So that that takes part in kind of a conventional loan essentially says, "Hey, I'm going to look at the borrower's credit score, how much they're putting down, and the health of their file to determine the mortgage insurance rate." Okay, so
Hmm.
that's why I say it can be super small or it can be very large.
Gotcha.
Um, so with that being said, on a conventional loan, let's say we have a first-time home buyer that qualifies for 3% down. They're going to pay mortgage insurance until they pay down to 80% of their principal balance or till they put 20% down. Once you
Okay.
put 20% down, paid towards your principal balance, you can drop mortgage insurance.
So they can
Um,
start with as little as 5% down, and if they're coming across a large amount of money in the next year or two, they can put that towards the principal, pay down, get above 20%, and then they wouldn't have to pay the mortgage insurance anymore. Is that correct?
correct, yeah.
Okay.
And as little as 3% on a conventional.
Oh, okay. And
So
is that
for
that's
a
only
first
for
time home
first
buyer.
time? For first time. Okay.
Yeah.
Gotcha.
Um, Now, FHA and USDA have mortgage insurance for the life of the loan, and they
Hmm.
have set rates. So the mortgage insurance on an FHA loan is 0.55%. So given our example of a $100,000 loan amount, that would be $55 a month in mortgage insurance.
Okay.
The USDA is 0.35% or $35 a month. So
Just again, so FHA you said is how much?
0.55% of your loan amount. So
Okay,
given our
so for a
example is
hundred
if you
thousand
have
dollar loan, it said it's 50, 55.
$55 a month.
Okay, so
Mhm.
let's say a typical purchase price of 300,000 in the area, they'll be paying 165 a month in mortgage insurance, if my numbers are correct. Um, okay, so it's
132 a month
132.
and 68. Yeah.
Okay. Um, so it's a sizable chunk, but it's not going to be a huge difference, and that's allowing now the FHA, a person would want to go with that. Is that usually because they wouldn't be approved for a conventional? Um, is it easier to get approved on an FHA?
Um, hard di hard question to answer. So why would you go FHA? So right now we have buyers. So with the if we take all three of those, the interest rate, funding fee, and
Hmm.
mortgage insurance rate, we get a number called the APR, which is the overall cost of the loan. Okay. Right now, as it stands where the market is sitting, an FHA, let's say a borrower comes to me and qualifies for a conventional and an FHA. If they're putting less than 20% down, the FHA for the most part is the lowest cost option for them.
Okay.
And it's because the interest rates on an FHA right now are much lower, so much lower than a conventional, that even with the funding fee and with the mortgage insurance, if they're still going to have mortgage insurance on a conventional, the cost of an FHA is lower. And so we can actually, we have systems that run that and tell us, hey, this is going to save them this many thousands of dollars over the life of the loan. Um, it breaks it down for us. And so it really is a case by case basis too, because so when we're looking at qualifying a buyer for a mortgage on a conventional loan, let's say someone is coming to me with a 615 credit score and they want
Hmm.
to put 3% down, their first time home buyer. I'm not saying they cannot get qualified for a conventional, but conventional is going to be a lot harsher and a lot higher cost loan, whereas the FHA is going to be more forgiving.
Okay.
Um, Typically will be the best option for them. Now, if they're coming with a 615 or putting 20-40% down, there's a higher probability we're going to get approval on that loan. Um, it just it really is a case by case basis, and not to answer like a politician, I really am sorry, but
Sure.
it really is. We look at the whole loan file and then look at the numbers change daily, and so
Okay.
we have to be looking at what is best for my buyer. And it might be something that is, you know what's most important to the buyer is they want to put the least amount of money down right now. They're not so much concerned about their monthly payment. They love the house that they saw. They just really don't want to put that much down. They want to save as much money as possible.
Okay.
Um, that might drive us into a particular loan product. Do you see what I'm saying? So,
Absolutely. Now you mentioned, credit scores and just their overall financial health. If someone's looking, say, to purchase a home in the next year, what are some things they can be doing in order to put themselves in a good position to be able to qualify for a loan?
I love that question. So, the first thing is that I am always happy. I know you're happy to talk to people. I am
Mhm.
happy to put them on a plan of action, kind of do that 15-minute like loan consultation initial call. I mean, just kind of see where they're sitting and where they could really improve. Really reaching out to someone, I think, is what I would recommend to do first, a professional in the industry.
Sure.
Um, and just understanding too that not every realtor or every mortgage professional is willing to take that time with them. And so understanding that and not getting discouraged if they don't get someone that is super willing to help, right? Just to understand. I've had so many clients come to me say, I wish somebody would have told me that 2 years ago. I reached out and I wasn't ready, so they just said sorry.
Absolutely.
um but understanding that I will put them on a plan of action, and then um, pay your credit cards on time.
Hmm.
I would say the number one source for having poor credit is missing credit card payments. So
Okay.
missing a credit card payment will literally drop your credit score 40 to 60 points overnight. It demolishes it.
Wow.
And so just even if you're paying the minimum balance, set it up on auto pay. If you have a $20,000 credit card bill, but your minimum monthly payment is $25, just set it up for $25 a month so that you
Okay.
don't miss that payment. Um, if you trying to think credit wise, that is my biggest piece of advice.
Okay.
Make sure you pay your bills on time. Get someone to help you. Once you get behind on those credit card payments or auto payments, it's really hard to come back. It just takes time. That doesn't
Okay.
mean it's not something that we can not overcome, but just ask for help instead of um, helping the ship sink, right?
Gotcha. Gotcha. And is there, if someone has like really poor credit, maybe they went through, a traumatic life event, sometimes a
Mhm.
divorce can be really tough on people's finances. Is it like all hope lost, or, even if they have poor credit, is there ways that they can recover? Are there specialists they can work with in order to get their credit back up so they can qualify?
100%. So there is always hope. I will say that. And we all go through really, really hard times, right? And so there is a ton of grace given, I know on your side and my side.
Hmm.
And credit reports always tell a story. And so you can see when someone has hit a hard or when they hit a hard time, and that's life. It's not a matter of if, it's a matter of when it's going to happen, right? And so if it's not something, when I pull a credit report, I have an interactive report that will allow me to give the borrower feedback on what they could do. If
Hmm.
there are bigger issues that need to be taken care of, I have a trusted partner. He's wonderful. That I mean, honestly, he's made miracles happen. He's phenomenal, but he also when it comes to credit repair, there are several industry professionals. I don't know. I wouldn't even want to call them professionals, but that will take advantage of someone that's in a hard
Sure.
spot. And so making sure that you are using, when it comes to your credit, I would not just look online and call the first Joe Smo. I would reach out to me or you and
Hmm.
say, hey, who do you know that is trusted to do a good job for me? Um, so I can help. I'll refer them to them. So
Gotcha. Yeah, and I've seen the work you've done and how you've been able to help people qualify, and some pretty amazing stories. So I tell people don't give up hope. Let's start the conversation, and people are oftentimes more able to qualify or just qualify for home ownership than they initially think. Um,
exactly.
so that's really good advice. We've covered some really good topics today, and this is, I think, a great introduction for for first-time buyers or repeat buyers who are curious about the process. I know we deal with this every day, but even someone who's bought a couple of homes, it may be 10 years since the last purchase, and information like this is a great way for them to refresh and just reassure them that it's worth starting the process, and it's worth putting in an application to purchase a home. Um, I'm curious. I know interest rates have been all over the place.
They
The
have.
past few years, they were really low. They got really high. They're kind of
Yeah.
coming back. Where are they at as of right now? Or just a range? And what are your thoughts? I'm sure everyone wants you to look in your crystal ball, but what is the industry saying for 2025 regarding
That's
it?
an awesome question. So we are where we're at today, to answer your first question, is the government loans, FHA, VA, USDA, are sitting somewhere between like 5.875 to 6.5.
Okay.
Conventional is sitting at 6.5 to about 7.125. Um, Historically, if you look, I love to give my buyers this resource. It's mortgagenewsdaily.com. It's a free resource. It'll
I
tell
love
you
that
what the
site.
national average is over the entire United States of America for rates for that day. I tell my buyers, I'm like, it just makes you a smarter consumer. So if you see that rates are at 6.9 and I'm quoting you an 8%, I'm not doing what's best for you. You know what I mean? And so makes you a smarter consumer. But historically, over the last 3 decades, a healthy interest rate for the economy is in the mid to higher fives. And so that is where for 2025, the Fed is projecting that we're going to kind of land. We're going to kind of start to fall and land somewhere in that healthy range. And so um, we've seen it pick up already. It's very exciting. I
Yeah,
know that you can attest to this, Judah, but when, you know, buyers will say, hey, I think I'm just going to wait for rates to drop. For every 1% that rates drop, 5 million more buyers enter that into the market. And so what ends up happening is the market always rights itself, right? So right now what we're seeing is a little higher interest rate, but buyers are able to get money from the seller because right, the sellers are sitting.
sure.
Whereas when rates start to drop and the buyers increase, then the seller's like, oh, hey, I can get,
Absolutely.
more
Yeah, and we
money. And
we saw
so,
that we saw that during COVID, where we had rates in the threes, but so many people were there were so many buyers and there were investors that were also getting these rates, and many first-time buyers were priced out completely, or they would
exactly.
be overbid by 50, $100,000. Um, so if someone's ready to buy, if your lease is coming up and you feel like you're responsible enough and you're ready for home ownership, um, it's oftentimes today is really the best time to buy,
Mhm.
um,
I would
because
agree with that.
yeah, and I know you've seen as well, and we've worked together on many deals lately, but for a buyer who's looking to purchase right now, sellers are much more likely to give concessions. If their home's sitting on the market for 3 months, 6 months is pretty average right now. I've been able to get buyers, 10, 15%, even more under asking, and you can often
Yeah,
come
you're
into
super
quite a
good.
bit of
I have to
equity.
attest to you on that. Coming in
Thank you.
low
Thank
and getting that credit towards closing. I'm like, man, what was
Yeah.
that one we had? It was like $25,000 towards closing
Hmm.
costs. I was like, oh my God, it's the most I've ever seen you got.
That one was pretty awesome. So
That was
yeah, I
amazing. Yeah.
love the negotiation part, and having a good team, an agent and a lender behind you, can really save you tens and tens of thousands of
Yeah.
dollars when purchasing a home. Well, this has been awesome, Annie. Is there any last words of advice that you'd want to share with people who are thinking about, applying for a mortgage for a home loan?
I would just say overcome your fears, reach out. The average age of the first time home buyer right now in the United States is 35 to 36 years old.
Wow.
That's how old I was when I bought my home and my first home. And well, maybe I was 34, but whatever.
Yeah,
That's neither
same
here
here.
nor there. But gosh, I wish I would have started earlier to build that investment portfolio and then seeing people my age that have 3 or 4 houses that can, they buy a house and then vacate that one and rent this one and buy a new primary. It's like, gosh, it's so obtainable if I would have just
Mhm.
started sooner.
Absolutely. I would say that the best time to buy was yesterday. The second best time is going to be
Yeah.
today. And the
Yeah.
sooner you get started, the more benefit you're going to gain from being invested in real estate and owning real estate, and creating that equity, and that wealth that can really only come
Exactly.
from real estate.
Generational wealth.
Absolutely.
Yeah.
Well,
You're
Annie, thank you
awesome.
so much. This has been absolutely awesome. I look forward to doing more videos like this and maybe diving into some topics more in depth, and just questions that I see coming up. So, thank you again. How can people reach out to you?
They can call me 512-738-1970. You can email me, Annie at anniewaneck.com. Find me on
Awesome.
socials. I am there as well.
Awesome. And we'll share this on Facebook and Instagram as well. And this has just been great. Again, I'm Judah
You're awesome,
Ross
Judah.
with Bastrop Real Estate Group, and you can reach me. My cell is 512-998-1957, bastroprealestategroup.com, or Judah Ross Realtor at gmail.com. And Annie and I would love to help you out. So thank you for watching. If anyone has questions, feel free to comment. Shoot us a text or call, but comment below, and we'd love to create more content like this. So thank you so much, Annie.
Thank you.